We do have a 6-hour mastermind on investment structures. I always try to bring it up at least for a slide or two because it's so critical to the success of any investor or anybody raising capital. And just like I said last month, if you're one of the 6 to 8 people that are here for the last event, many times deals we've gotten done, we are told literally these exact words. No, thank you. This is not going to work out. You don't need to follow up again. You're wasting your time. We're never going to do this deal together. And then I offered a different structure just a day or two or a week or a month later, and we get the deal done. So no just means not right now with that structure where the market is at that price, at those fees, or at those terms. Doesn't mean, even if they say go away, don't ever contact me again, doesn't necessarily mean that. That's what I found, right? So you want to be politely persistent and creative and open-minded and look at how they prefer to structure deals. And a couple of just real quick examples. When you form an LLC, you could have all different share classes, one that has voting shares, one that does not, one that has control, or one that has negative controls to prevent them from getting diluted. You could make it so share class A gets all the dividends till their investment is off the table, so they're 100% de-risked, and then the share classes share pro rata in the profits going forward. So they get de-risked first, almost like a preferred return clause in a fund. With one deal, I had put $150,000 into it. We went to one investor, the first investor we went to for the other $350,000 we needed for this piece of IP. And they said yes, because we told them, your money will come out 100% first, then my money comes out, and then we share it pro rata. With some deals, you can make it so it's very favorable to the investor getting de-risked, but then they're capped at a 2x return or a 1.5x return, and you get everything above that because you took on all the risk and you took on all the work of adding the value. It goes way deeper than that. Like I said, we could talk for 3 to 4 hours just on structuring deals. If you haven't gone down that rabbit hole as an investor with raising capital, because then you can turn a no into a yes, and you can make it 4 times more likely that someone says yes. The exact same deal, show me an average deal, I can make it amazing or super aligned. Or you show me a lame, if you show me a really good deal and it's structured badly, I don't want to touch it with a 10-foot pole for a sophisticated investor. So you need to be very sophisticated in this, and it pays huge dividends to do that. After lunch, we're going to talk about extreme actions you can take to source the best deals possible. At the end of the day, you're going to hear from Michael and how connecting with the shark from Shark Tank that he met through Family Office Club boosted his deal flow and what that did for him in terms of his growth and his balance sheet, et cetera. But blackmail is where someone says, if you don't do this deal with me, I'm going to break your window, or I'm going to expose these documents or show what a family member said on Instagram or something, right? Whitemail is like, you don't have to say anything. People want to do a deal with you because you're Oprah Winfrey, because you're Warren Buffett, because you're Ray Dalio. So they'll go out of their way to help you just for that small chance of doing a deal together. It's the opposite of blackmail. And so you will get amazing deal structure terms if you're positioned well. We talk a lot about positioning here, playing a unique game, describing things in a one sentence statement so everyone knows exactly what you're looking for. That's part of getting amazing deal terms, but also part of it is you have to know how to design those terms, because you might get a chance to structure something however you want to. And if you don't know how to structure it like this, the deal just moves slower, or now you have downside risk. And if you would have asked for collateral, you could have, cut your downside risk in half or had almost no risk in the deal. And so it's really important. And all these concepts we're talking about are all connected to each other across all these masterminds and workshops. And I think you'll see that throughout the day today. Any questions on this slide? Some of you have heard some parts of this before, but I think it just wouldn't be doing a service to people in the room if it didn't bring it up. And we do have recorded content on this. If you want to go deep on investment structures, we have 3+ hours of content on this topic instead of just 3 minutes that we're spending today. Within our charter portal, and you can talk to Jennifer outside on how to find exactly that event. But any questions virtually, Andres, just let me know and call them out and I can answer those. Raise your hand if any questions come up. So one thing that stresses in his book called Poor Charlie's Almanac, he passed away, I think it was last year. He's Warren Buffett's right-hand man, and Warren Buffett calls him the architect for everything that he built at Berkshire. And so he changed. Warren Buffett used to look for cigarette butt companies that had a little bit of life left in them, and he'd buy like a really distressed company. And Munger said, that's great. If you you want to be small, great for making some money, but it's not scalable. And it's way more scalable if you can buy a great company at a fair price instead of a cigarette butt company. And Munger says that all of us operate on a lattice work of mental models, and we always need to be upgrading the mental models that we operate on. For example, different investment structures. There's different mental models related to thinking about the negotiation of a deal, thinking about how to position the brand and the one-liner in your logo and thought leadership, etc.
Join the Family Office Club by visiting familyoffices.com. We look forward to seeing you at our next live event.